is in good position. But even then, is good or bad? We don't know. We need to compare. Percentages are always written to compare. You cannot just make the opinion just based on one ratio. You need to have other ratio as well to compare. Then you can say that the RBC is in good shape or not. Right? So if you want to find out margin of safety in units, we can also do that. Right? There are multiple ways to do that. You can find out the margin of safety, $50,000 divided by sale price. Answer is 100 bytes. Or you can find out the units sold, current units sold minus break-even units. Answer will also be 100 bytes. Concept is the same. You can derive any formula you like. Understand? The margin of safety can be in percentage, can be in units, can be in dollar sales, or can be in dollars, right? So if you understand all these concepts, please answer this question. 2,100 cups are being sold, right? So what is the margin of safety expressed in cups? You need to find out margin of safety in units form. Please calculate that. So first you have 2,100 cups. That is your current sales. You just need to find out break-even units. That is your margin of safety in units. We know that this is 2,100, and break-even units are, what is the formula for break-even unit sales? Fixed cost, which is 1,300. Let me just write it down here. Fixed cost divided by CM in units. That is break-even in units. What is the answer here? B, right? Everyone, any question?
Sir, can you repeat it again?
Okay. Here we go. Again, one more time. The rest of the question is the same. Sale price is 1.49. Variable cost 0.36. Fixed cost 1,300. They are selling 2,100 cups. So you need to find out margin of safety expressed in number of cups. So margin of safety is equal to, if it is in units, then your current sales unit, your current quantity minus break-even quantity is equal, that is your margin of safety. In terms of dollars, margin of safety, dollars, that would be your current sales, dollar sales, minus break-even in dollars, right? So we need to find out margin of safety in units. Currently you are selling 2,100 cups. All you need to find out the break-even units. What is the formula for break-even in units? Fixed cost plus zero target profit, right? If we use target profit formula as well, so we just need to put zero target profit and CM in units. Fixed cost is 1,300. CM is 1.49 minus 0.36. Sale price minus variable cost. So if you divide 1300 with 1.13, you will get 1150. Right? So your current sales in units minus your break-even sales in units, answer is 950. So you are selling 950 cups above your break-even point. So your margin of safety is 950 cups. Understand? Or if you are using the slide formula, that would be a lengthy procedure, but that would be, we also solve this through that one. So find out the margin of safety in dollars. So use this formula. So your current sales are 2100 multiplied by 1.49. Answer would be and your break-even sales, you need to find out. The break-even is equal to fixed cost divided by CM ratio. What is the CM ratio? CM ratio we calculated in our previous slides. It was 0.758. So 1300 is your fixed cost divided by 0.758. So we calculated it as 1715. Answer would be 1414. So that's the dollars. We need to find out in cups, right? So if you divide it by sales 1.49, you would find out the cups. So 1414. 949 something. So that would be B as well. Right? Now it's clear? Camille,
Yes, thank
Sunho,
Yeah, it's clear.
William, Stella,
Yes,
William, Timay,
Yep.
Leo, Minsu,
Yes.
Jackie, Alima.
Yes.
Okay. Now cost structure and profit stability. So cost structure refers to relative proportion of fixed and variable cost in an organization. So managers often have some latitude in determining their organization cost structure. What they say? They say that there are advantages and disadvantages of high fixed cost as well. Right? So if we talk about the advantages of having high fixed cost, which means low variable cost, is that income would be higher in good years compared to companies with lower proportion of fixed cost. Right? Income would be very high in good years. Disadvantage is that income would be lower in bad years compared to companies with lower proportion of fixed cost. Right? So companies with low fixed cost structure, which means higher variable cost, enjoy greater stability in income across good and bad years. So what do you conceive from this sentence? It means we must keep track on fixed cost, because fixed cost, even if our marketing department pushes sales, even if we decrease our sales price, even if we decrease our variable cost as well, that impact will be wiped out by increase in fixed cost. When we have seen in our previous lecture that we increase just 10 to 20% of our fixed cost, but we will see only small increase in profit as compared to our variable cost. We increase our variable cost from 20 to 30 to 40%, but still we are able to earn more than 33% of the profit, right? So in our previous slides, we have seen that the magic of having low fixed costs is that it will give you higher income across good and bad years. So that's why the companies, they are very, very curious about having fixed costs. So that's why when you go to the company and ask about, I want to do a job here, so they will say to you that, so you work here on commission basis. Why? Because they don't want to increase their fixed cost by giving you fixed salary. Now you understand that? Okay, so again, please take the picture. And this is our last activity here. So it comprises of 5 parts. So please take a picture first, 1, 2, 3 parts, and then take the next. Here we go. Take a picture. And this is also individual activity, not the group activity.